Simon Brown today presenting Know Your Platform. So I'm going to be looking at the gold commodity multiplier that has been issued by Standard Bank. This is available obviously on the online share trading platform, and it's obviously available more broadly as well. But I want to really dig into, what are we looking for? What are the concerns? What should be our concerns, if any, and to understand these sort of structured products as and when they come through. If you're logging onto the Standard Bank website, the online share trading website, you will see it right there, gold commodity multiplier. And if you click on it, it gives you the closing date, which is 14 August, which is Friday, 2 weeks. So we've got 2 weeks for thinking about it. And it goes through, it gives you a fair bit of detail about it. I'm going to delve into the detail in a moment. I've downloaded the documents that come with it. Minimum ZAR value is 50,000. Increments thereafter of 5,000. Always massively important that you make those minimums and the increments, otherwise you get booted out. It gives you the closing date, documentation, etc. And obviously, if you apply, you disclaim that you have, done your homework. Disclosing the upfront fee, which is 2.5%, that will go to SPG, Standard Online Share Trading. 2 documents, a full brochure and a 2-pager. And then importantly, the account that you want to apply into, available funds, in my case, insufficient, 35 Rand and some cents. ZAR amount that you would want to be applying for. That, of course, is 50,000 minimum, and then your 5,000 thereafter. And then you would click, yep, done, and it would be applied for. This is not an IPO. This is an IPO, but not in the sense of a company listed. Typically, when a company is listing, there is a finite amount of shares available. In this case, I suppose there is a finite amount, but that finite amount is going to essentially be how much gold is there in planet Earth. So broadly, with structured products such as this, with exchange traded funds and the like, there's no cap to it, there's no rush to it, and anything like that. I mean, you will get your allocation, absolutely no problem whatsoever. And what I'm looking at, so here is the document as issued by Standard Bank. It's about 12 pages or so. And it goes without saying is that it's important to read through the documents. And of course, it's massively important to make sure that we actually understand what we're looking at. Almost every product is going to have pros and cons, risks and rewards. And that's not a bad thing. That's just how it is. And we need to be happy that we fully understand the pros and rewards, and that we also fully understand and are happy with the risks and the cons, in a sense. Boring page there. We can skip down to what does matter. Was my screen acting all funny? So in essence, it's an enhanced gold-linked investment referencing the performance of USD gold spot price. That USD gold spot price is important because that implies dollars. Commodity investor potential participating in the growth up to a maximum of 40% in US dollar return. In other words, in US dollars, you are capped. Now, I'm going to come back to the US dollar part, because what's important here is you actually are investing in ZAR. And this document goes into a fair bit of detail, but you're going to get a maximum of 40% in US dollars. So, understand your risk in that sense. What's also important with it is the product is 100% capital guaranteed, and it therefore shields investors from negative performance in the gold price if the investment is held to a maturity date. 2 important points there. 100% capital guaranteed. You will get your money back, no questions asked, if you hold to maturity date, which implies, and this is important, so this is obviously a term document, and it therefore runs for a finite period of time. That capital protection only applies if you hold until the end of term. What they have done, or will do when it starts trading, is they're basically saying to folks, look, this is a term period, you should hold it until expiry, but hey, sometimes stuff happens and you might need to get your cash out sooner, in which case you can get the cash out sooner, but at that point, your capital protection has fallen away. It only works if you hold until the end. Issued in the form of a note by Standard Bank of South Africa under its 60 billion structured note program. In other words, your counterparty risk is Standard Bank, because you're always taking counterparty risk. Someone has to issue these products. Now, if I'm issuing one of these products, you're going to say, with respect, Simon, we want to see your balance sheet, we want to know who you are, and even having seen your balance sheet, knowing who you are, probably thanks, but no thanks. In the case of Standard Bank, your risk is that Standard Bank goes bust. And I think we can I always say, never say never, but if Standard Bank goes bust, your gold investment is truthfully the least of your worries. You are queuing to get into Zimbabwe or whatever the case may be. So you do have what we call counterparty risk. Now, sometimes that counterparty risk is easy. In this case, it's Standard Bank. With some of the other banks who issue structured notes, some of the stockbrokers who issue structured notes, they actually issue off third-party balance sheet. In other words, your risk is not necessarily them. We were chatting, Investec had their China Seas one recently, and they actually used Standard Bank debt in a sense. So your risk was Standard Bank. Rand Swiss did one recently as well, and they use a European bank. So your risk, your counterparty, is essentially that third party. In this case, that third party is Standard Bank. At the end of the 3-year investment will be redeemed, and the investor will receive one Invest Gold ETFs equal to the full investment. So it's important you're not going to get paid out in cash. In essence, you will get paid out in terms of a gold ETF, which of course you could then go and sell. You then own that ETF. There might be some roundings in it. What's it trading at? 317 ZAR and a couple of cents. That's a weekly chart. Let's drop it to a daily chart. So you're going to get paid out the ETF. And it'll be, pro rata to whatever the value is at that point, of course, however it has worked. Some other important points: minimum amount 250,000. However, for online share trading, as we saw a moment ago, they've done a deal, and this is often the case, where it says they can do 50,000. There we go. Shaman, I was getting to your question before you asked the question. So it's oftentimes, there will be minimums, but particularly with some of the online brokers, Standard Bank, for an example, they're going to get a fair, online share trading is going to get a fair bit of flow through it. So they're like, cool, you know what, we'll actually waiver that minimum to be a lower 50,000. And you might find some of the other brokers doing the same. Often if there are minimums, now in the case, Standard Bank's come and said, cool, there's a minimum, but we're going to run that minimum at a more modest, so I've got messages coming in. We're going to run that minimum at a more modest level. But if you don't like them, so in this case, don't call them up. But sometimes you can, contact the broker and say, hey, that minimum, a little bit scary. Any chance we could perhaps get a little bit lower? Look, your answer is going to be no most of the time, but sometimes not. In this case, minimum 50,000. Investment term is 3 years. So in other words, from issue date, and we'll get to that in a moment, because issue date is not necessarily closing date, you're expected to hold 3 years to get the key benefits. And those benefits are capped exposure to the growth of the gold price, up to 1.33 times enhanced. So in other words, if your capped exposure is at 40%, in terms of gold price, you can't get more. Now, ZAR you can. I'm going to come to that. It gets a little complex in that in a moment, but let's park that for an aside. So if gold is up 30% in the period, you will get 40%. If gold is up more than 30% in the period, you will get 40%. In other words, you get 40%. And just from a background, what Standard Bank's done in the background is they've obviously sold calls, so it gives you some, and bought some calls, sold some calls, and bought some puts to structure the option around it. It is, so you get a little bit of gearing on the gold price, you get it capped, and it gives you 100% capital protection at maturity. Again, I stress that at maturity, because as I say, you can exit early. They will make a market for you, so you can exit early, but that early exit is not therefore giving you that. Now, you might exit earlier, but gold is run and you'll do okay, but you don't necessarily get that capital protection. Key risks: Well, an early redemption means you might not get it. And commodity may act as a South African Rand hedge. Yeah, it acts as a hedge. We'll touch on that in a moment. This is the important table. Now, they're always going to set out these sort of tables. They've taken the 250,000 minimum, but let's touch it. Let's run with that anyway. So gold grows by 70%. That's really lekker. And Rand remains flat at 15. So important point here, ZAR flat at 15. Gold grows at 70%. You just get 40. You only get the 40 because remember, it is capped. If gold grows by 20%, you get that enhancement, so you get 27%. Now, an assumption that ZAR hasn't changed over that 3-year period. So there, if gold is growing at 20%, you get enhancement. If it's growing at 10%, you get enhancement. Basically, up to 30% growth in the dollar gold price, you will ultimately get enhanced, but anything above 40% and you get zero extra growth. And then, of course, gold declines by 10 or by 50%, whatever, you get your money back. In other words, you take no hit whatsoever. But what happens if the ZAR weakens over the period? You're going to get a double whammy. So same numbers here, a 70% growth, which means your gold growth is 40%, but you also got some ZAR depreciation, which actually gives you ultimately that 40%. So you've taken the two winners. And what I mean by that is, remember, there are going to be two parts playing here. The first part is gold price in US dollars, and the second part is the ZAR. So you do catch that ZAR move happening at the same time, whatever that ZAR move might also be. James, if you can exit early, can you enter later? There would be a market maker. No. So what then happens is, no, the market maker is only buying, they're not selling. So they're just a buyer of the product. They're not going to be a seller of the product. Now, in theory, you could sneak in and put yourself into the buy side, get onto the bid, and then how does minimum and capital protection works? That's a fair point. Minimums, I imagine, would fall away, although the tranches are going to come through in large sizes. And the capital protection, I suppose it's there. Question around the 2.5% fee. I'm going to touch on that in a second. So in this case, you've got stronger gold and weaker rand, and you get the double win. Of course, if you get your capital guarantee, you hit that capital guarantee and you don't get anything. You just get your money back if gold is depreciating. If you're looking at it here, where the rand is actually strengthened, that takes some of your shine off. So gold up 70%, but you're capped at a 40% growth, and then because of ZAR strength, you're only going to walk away with 35%. Again, no worries if there's declines. Shaman, the question around fees. So the fee is built into the price. In other words, you put in your 50,000 ZAR as an example. From that 50,000 ZAR, Standard Bank do a whole bunch with it. They put some option strategies in place. They buy some linkers and the like, etc. And they pay the fees from that point. They're not only paying a fee to the broker, who in this case is Standard Bank, but of course they're also paying a fee to the Standard Bank, the team who've structured this, part of the structured note. So the fees are there, but the fees are built into the process. So you deposit 50, you get back 50, you've paid your 2.5% fee. So the fee's just been disclosed just for purposes of transparency. So understand this table. This is your very, very important table. This is what matters. You're not going to make more than 40% in the dollar price of gold. Rand weakness will benefit for you. Rand strength will, of course, take some shine off it. And if you hold to the 3-year term, you will get your money back exactly, regardless. So minimum investment, 250, it will deliver, this is a very important line, at the end of the 3-year investment term, it gives them to the value at expiry. They're going to give you the One Invest ETF gold tracker. So you're not going to get cash. Now, of course, as I say, you can take that ETF and you can sell it, but you're going to essentially be handed it. And obviously, if we're in this scenario here, where gold has done very well and massively outperformed, you're actually going to get less units than you would if you just bought it up front. Where you're really going to score is if it's gone under pressure and gold has actually gone backwards over that particular period. So main terms: enhanced capped, upside based in US dollars. There will be rand hedge structure to it, 100% protected at maturity, and then a 3-year term. So question is, who should be looking to look in this? Someone who's interested in gold but a little bit risk averse. You think gold looks interesting, but you know maybe it's run too far too fast. Maybe everything's going to be fine. You want some exposure to gold, but you want it in a lower risk environment. Gold is, there's a very good story around gold right now. Whether that story will last 3 years, truthfully, no one knows. It's also important that someone investing in this product is simply not wanting to need the money in 3 years, and again, who don't want to use their offshore allowance. Who should not invest? So if you are extremely bullish and you believe that gold is going to be doubling in price in the next 3 years, or not doubling, anything more, if you expect more than 30% appreciation, and let's For ease of sake, let's say gold is currently $2,000. If you think in 3 years' time gold will be north of $2,600, then this product is not for you, because you will actually give up some of that upside. If you need the money within the 3 years, obviously don't touch it. And if you're wanting income coming through, because this does not pay any income. So there's certainly pros and cons to it. The pros to it are very much that capital protection, and the cons are very much that you are capped. So if you sort of sit in that place where you kind of like the gold story, but you're not 100% convinced, this could be a product for you. If you think gold is the thing to be owning over the next 3 years, and that it's going to be, double in value or triple, crazy numbers like that, then don't touch this. And if your time horizon is shorter, again, don't touch it. Additional costs, there are none. All costs are built into the product. So you put your 50,000 in, your 50,000 is allocated, and then the costs are taken out of it. So you don't, the costs are there, they're being disclosed, but don't worry in the sense that you're going to get taken on it. Tax implications. Obviously, speak to your tax experts around it. Profits or losses, there won't be any losses in this case unless you exit early, but any gains obviously will have a tax event. And because they're going to close the product and pay you the ETFs, that may trigger a tax event. In other words, you may, if you've made a profit, have tax to pay. It might be CGT, but you might very well need yourself find yourself. And what I mean by that is you get, so you put your 250,000 in, and let's say you get 300,000 out at expiry, just as a random number I'm picking. Very nice and all, 300,000. SARS is going to say, hey, you've made 50,000. We want you to pay tax on that. Now, you haven't received the cash because, of course, you got the ETF. You're going to have to sell some of those ETFs to realize it. Alan, your benefit is a little bit of enhancement if gold is up 30% or less. And the big benefit, of course, to this is quite simply, in case it goes against you, that you've got a capital guarantee. So those are your two benefits. If gold is going by less than 30% over the next 3 years, and if in fact gold is going down over the next 3 years, this product really, really works. And it's risk adjusted. I see some of you in the question saying this is just silly. No, sure. I mean, for some people, you look at this, you're prepared to take the risk. If gold is falling, I'll exit it. Or you're one of the gold bulls who thinks that gold still has significant upside. Make no bones, there is a compelling story for gold as we sit here in July 2020. What that story for gold will be in July 21, 22, and 23, I don't know. I mean, it could be as compelling, it could be more compelling, but let's take a scenario where tomorrow we wake up and the pandemic is gone. I don't know, COVID-19 left. And make no bones. I mean, I'm being silly here, but there are scenarios other than end of world which requires some gold. So a nice visual representation. You get that outperformance as gold goes, but as soon as you hit the one, it just taps its way out, and you're not going to get any better performance than the 40% return. This is obviously gold in dollars, and of course, you will get your money back, no questions asked. There's two scenarios where you don't get your capital protection. The one scenario is you exit early, and the other is that Standard Bank goes to the wall. There is daily liquidity, although, and I stress again, daily liquidity does not give you that capital protection. Applications, nice and simple. We had a look at that right up front. A whole bunch of legal processes, forms. Come on, be scrolling. Play nice for me. Be scrolling. What I'm looking for, more contact details if you're looking for more. What I'm looking for is the term sheet in essence. And I think I've gone past it with all the particular dates, listing dates, etc., etc. Where is my term sheet? Term sheet is page 10. Okay, let's get down to page 10. Sorry, folks, bear with me. I should get a mouse. I don't have a mouse on this computer, so I just use a trackpad, which is nice, but then sometimes a mouse would actually be even more nice. There's what I'm looking for, the term sheet there. So Standard Bank is the issuer, commodity, you can track it, invested in ZAR. Spot will be the London spot. FX final listing on the JSE, initial commodity observation plus 2 weeks, which is therefore 28th of August. Maturity will therefore be 28 August 2023. Maturity will then be 5 days after, just because there's settlement and the like. Enhanced growth, we get the 1.33, we get the cap. Anything above 30% you're simply not getting. There will be daily liquidity. Price is built into it. There is a 2.5% inclusive of VAT upfront fee, but the fees are priced into the commodity with 100% of allocation. No, so it'll start on it'll start on the closing date into the initial, we'll do it. And what we're seeing, initial commodity observation date will be 26 August. So it'll be 26 August will be the set date for pricing, and then it'll list on 28. Rashan, commodities in the offering after launch and in the app. Yes, so you'll be able to track the offering, because obviously, so if you buy it, it'll sit in your portfolio, it'll have a code, and therefore you'll be able to track how it is doing. And of course, you can just go and track the gold price in dollars, and of course you can track the ETF at the same time, so you can catch it from there. Is there an upside allocation limit? Susan, I honestly don't know. I mean, I suppose at some point, but I mean, put the number in and see how many zeros they object to. I mean, in essence, you know, the issue here. Now, if you come with $1 billion ZAR, then that, you know, but they're going to go and hedge the position. They're going to need to buy some of the ETFs, etc. It would have to be a heck of a lot for it to be a price-moving event. So maybe there is to some degree, but Standard Bank's got 60 billion in various different structured products, and there's probably a couple of 100 billion. Now, obviously not all into gold, but is there an upside? Probably not. Back to, so there it is there. That is the One Invest ETF. Trading, as I said, 317 ZAR in some sense. So this is 100 ETFs are equal to 1 Kruger Rand, or 1 ounce of gold, as the case may be. Question coming through. It's a question. Couldn't I just go and buy some Kruger Rands? Absolutely, you could. Or you could just go buy some of the ETF. You absolutely could. Just quick point on the Kruger Rands. You will note that the Kruger spot price is actually trading somewhat above the actual. So the theoretical price for gold is 31,700. Buyers in the market paying 32,700, and sellers 34,490. So that's just the demand factor. The Rand refinery is actually struggling to keep up with demand for Kruger Rand. But absolutely, if you don't want the capital protection, or you think that gold's got a much better chance of doing way more than 30% over the period in dollars, or you think, you know what, if gold starts to collapse, I'll close my position. Absolutely. And this is always, I said right up front, there's going to be T's and C's, and you've got to decide if you're happy with those T's and C's or not. And if you're not happy with them, if you think, nope, this isn't a product for me, then it's not for you. This one is moderately niche in that it's for folks who are thinking that gold 30% over the next 3 years. Got some wariness around gold, I suppose, is perhaps the better way of looking at it. Question, could you apply in different online share trading accounts? You absolutely could, but there would be a 50,000 minimum per account. So you can see I've got the multiple accounts up there. You can apply in different ones, but it is going to be a case of that you would have to do 50,000 each. Another question, can you put it into a tax-free account? The answer is no. 2 reasons. One, it has enhanced return, and the legislation around tax-free accounts does not allow enhanced return. I think you can use options to protect downside, but you cannot enhance return. The other issue is that this is a commodity ETF or commodity product, and therefore you cannot do commodity products into a tax-free. Yeah, so that's the trick. And the tax-free legislation, as was 2015, quite clearly states that you cannot take you cannot have any enhanced return within a structured product. So a structured product can go into a tax-free account. Absolutely, it can, but not if there is it needs to fit within the rules. And one of the rules are no performance fees, no single commodities, no single stocks, and very important, no enhanced returns. Fred, Standard Bank fee 2.5% is one off. And the thing with the fee, and it's the way they're structured. So what Standard Bank doesn't just do is take your 50 grand and drop it into the ETF, because that wouldn't work. They take your 50 grand and they basically do option strategies around it, focusing on the gold price, in dollars, and they've got currency hedges in place, and that's how they give you downside protection. They basically use put warrants, and they give you upside enhancement with call warrants. So they buy calls, they sell puts, and then they sell calls at $30 up at gold and dollars as well, and that's why you get a cap at that $30 level at the same time. And within that process, then they're enhancing the return. There's money left over for paying the fees, which includes costs to Standard Bank as the issuer of the commodity linker, and profits for them, and then of course to the introducing brokers as well. Michael, so the 5,000, so the limit, the minimum is 250,000 for online share trading clients. The minimum is 50,000, and then in multiples of 5,000 thereafter. That line there. So although the product is a 250,000 minimum, online share trading is secured that at a 50,000 minimum, and then increments of 5,000 thereafter. And that's typically, but both of those processes are not unexpected. Standard Bank will often negotiate a lower minimum, and then there will be a set multiples as increments thereafter. Am I investing into this? No, I mean, I don't, I'm in a weird position where I own 1.5 gold stocks, and I say 1.5 because one is Sabania, and they're actually more PGM than gold these days, and then I own some Pan-African. I don't own gold directly. I want that leverage impact we get from the gold miners, and I will at some point be looking to take my profits. I don't look at gold as an investment more than, it's a speculative position for me. So don't get me wrong, I'm enjoying the gold position, and my Pan-Afs are doing great, my Sabania Stillwaters are doing great, but gold to me is something you need to be able to head to the exits. I was interviewing Derek Janser from Rensburg today, and he's like, with commodities, always stand close to the door. And a structured product is not, for me, close enough to the door. But that's a personal thing. I've literally, for the first time in my life, and I've been doing this for decades. For the first time in my life, I own gold stocks. I always used to tongue-in-cheek say the only time I bought a gold stock was when you closed a short, and that was really it. And it's this chart here, which I have shown you folks before, the J150, which is the gold mining index. This was a 20-year consolidation that is now massively broken out. And you want to be involved in that breakout. That breakout was, you could argue somewhere between 28 and 30, sort of 600 on the index. And you want to be holding that breakout. You absolutely do. It's technically targeting 6,400. So in theory, it's hit the target. But truthfully, gold is a strange beast. And, I know the arguments for gold and blah and all that sort of thing, but truthfully, when the first pandemic in 100 years arrives, well, then that argument for gold now suddenly actually becomes valid. To my mind, this is your first time that it's actually been a good time to hold gold. I don't know what gold was doing 100 years ago, but now is the right time. And I prefer the miners because they offer you leverage as opposed to the actual straight gold itself. The typical view is, and this is not my view, so don't quote me on it and don't hold me to it, is that if you're holding gold, you should probably have around 10% of a portfolio. But if you're holding miners, you can get away with 5% of a portfolio because miners will easily do twice what gold does if gold carries on running. Do I think gold will break 2,000? Sure. I mean, why not? I mean, what's the upside limit for gold? I have no idea. I mean, I own, so the glory stock that I own is Pan. And the trick I have, and I've been chatting with folks for the last last week or so, is like, when do you sell this thing? I mean, how do you? I mean, it's down today. I mean, it makes no sense. But when do you sell that miner? I have no idea. This is new territory for me. But for now, I'm holding and enjoying. It's fun to be long gold and making money off it. Ladies and gents, we will park that there. No more questions coming through. Everyone, we will be back again on Friday. As always, if you have questions or things that you would like me to be covering, let me know. Simon@justonelap.com. You're welcome to send me ideas and theories. Happy to chat around that. And then, of course, back Monday with dinner. Everyone, have a great day further. Stay safe, wash your hands, and wear your masks. Cheers all.